Holy smokers, this ain't no dang jokers. I spent a few dollars here today. A very abnormal buy. Spent over $50,000 here today on 7 stocks. Yes, a very abnormal buy. Very out of the ordinary for me to purchase this much of stocks in a day. So I want to go ahead in this video and talk about each of these 7 stocks, why I went ahead and bought them. A pretty heavy amount. Is it as heavy as I could have gone? No. I was actually going to do $100,000 today. Then I thought about it and I said, no, let's do 70,000. Then I thought about it a little more and I said, no, 50,000 sounds like the perfect amount here today. So we'll go through the stocks. Appreciate y'all joining me. It's going to be an action-packed video. All I ask in return, smash a like for this video and make sure you're subscribed here to the channel, which did you know about half the people that watch my videos on a daily basis aren't subscribed, which is kind of fascinating to me, thinking about how many subscribers the channel has. 728,000, and how a lot of people that watch my videos day in and day out, you guys aren't even subscribed to the channel. What the heck, man? Go ahead, hit that subscribe button, man. All right, appreciate y'all. Let's get into this. First of these 7 stocks I bought here today, Shopify, ticker symbol SHOP, Shopify. Went ahead and bought over $20,000 of this stock. It did dip under $60 here today. Now, Shopify stock has been brutalized the last 3 months, like kind of on the DL in my opinion. Not a lot of people are thinking about Shopify as really being brutalized this last 3 months, but absolutely. Over 35 percentage points this stock is down in the past 3 months. That's an incredible fall. Now, do keep in mind, Shopify is still recovering on a 3-year basis. 3 years ago, this stock was $100+, right? And it's down 52% from where it was at, 3 years ago. Not even from the highs, just from where it was at 3 years ago. So this is still a company and a stock in recovery mode. Now, I shouldn't say company because it's not like the fundamentals ever fell apart to this company. We're about to go through the fundamentals. Then they're better than they've ever been by a long way. Things are phenomenal, but the stock price has been anything but phenomenal the past few years. But we're still in an uptrend, and we will take out these previous highs and we'll absolutely blow those previous highs away. Now, for Shopify's business model, they just came out with earnings a couple days ago. They had gross merchandising volume was up. GMV was up 23% year over year. Revenue was up 23%, but keep in mind, this is a more important number. They sold off their logistics company last year, okay? So if you exclude that logistics company, basically revenue was actually up 29% year over year, which is very good, folks. Very good. Merchant Solutions was up 20% for the company. Subscription Solutions was up 34% for the company. Gross merchandising volume processed by Shopify payments, GPV, very important. That was up 32% year over year. Now, penetration in terms of how many folks are using this of Shopify's base, 60% now versus 56% at the same point last year. So Shopify payments is a huge hit for this company, an absolutely huge hit for them. Monthly recurring revenue, MRR, is now up to $151 million in monthly recurring revenue for Shopify. That's up 32%. Incredible numbers for Shopify here. Gross profit was up 33% for the company year over year. I love to see that. And the reason I love to see that is when we look at revenue was up 23%, right? 23%. But meanwhile, the gross profit's up 33%. So basically, gross profit was up 1,000 basis points more than revenue was up. That's very good. Okay, very good. Now, on top of that, total company gross margin came in at 51.4%. That's versus 47.5% in the same quarter last year. If we look at subscription solutions gross margin, 81.4% versus 78% in the same quarter last year. Merchant solutions gross margin, 40.1% versus 37.2% in the same quarter last year. Phenomenal. Operating expenses shockingly fell 4% year over year. Now, that's incredible, and I put a wow next to that because when you think about a company that's growing revenue 23% year over year, you don't usually think about operating expenses being down. Usually operating expenses are going to be up. So the fact that operating expenses was down 4% with a 20% plus growth rate in revenue is astronomically good for this company overall, okay? Now, if we look at free cash flow, that exploded to $232 million in this latest quarter for Shopify. That's versus $86 million in this same quarter last year. Free cash flow margin exploded higher to 12% versus 6% in the same quarter last year. That's really good. As far as outlook for the company, high teens percent growth. My guess is they're kind of talking 18, 19% growth is what they're thinking for revenue. Now, that is a deceleration from the 23% we saw in this last quarter. So that is something to factor in there, right? And I think that's why the stock got hit. It's just, anything is seen as negative. Wall Street's very quick to act, especially when the market's had a very nice run. They're looking for any reason to sell stocks. And so for a company like Shopify, if you can get a guidance on a sequential basis that's a little weaker, right, than the previous quarter, that gives them a reason to sell. Low to mid 20% growth if you exclude the logistics business, which is very, very strong. Now, it's important as an investor, as a real investor who's thinking about companies and owning these companies for the next several years, and you're not just in it for a breadcrumb and hoping to make $1 on Shopify stock tomorrow, right? It's very important to factor in the long term. What's the long-term trends with a company like this, right? The long-term trends are astronomically great. Here's a deal for Shopify. 2013, they did $50 million in revenue. Then 2014, 105, 205, $389 million revenue. 2017, they do $673 million of revenue. In 2018, it was a big year for the company. They crossed $1 billion in revenue for the first time ever. 2019, $1.5 billion. 2020, $2.9 billion. 2021, $4.6 billion. 2022, $5.6 billion. 2023, over $7 billion of revenue. In 2024, basically, in my opinion, they got $8.5 billion plus in the bag, which means 2025 should be the first time ever the company hits $10 billion plus in revenue in 2025, which will be extremely exciting. So think about this for a moment. In 2025, they're likely going to do $10 billion plus in revenue. And in 2018, it was the first time they ever crossed $1 billion of revenue. So from 2018 to 2025, from $1 billion to $10 billion plus. That's incredible. Absolutely incredible for this company. That's a great long-term trend. No, in terms of Shopify, go to 1000xstocks.com. I have a massive amount of different valuation metrics on that. That's just my personal service I use that I created myself, right? Well, me and my developers, I should say. And forward P on the stock 55. So it looks high, trades much higher than the market, but it's also got growth that's far outpacing. Like, how many companies are seeing their gross profit up 33% year over year? How many companies are seeing their revenue up 23% year over year in this sort of environment? Not very many. Like, you're going to have to pay up for a company like Shopify. I wish I could get it at a forward P of 20. I would have bought $500,000 worth of Shopify to stock today if I could have get it at a forward P of 20, but it's unrealistic. At the end of the day, great growth companies like Shopify that have 5-10 years of growth, not 5-10 years, I should be saying more like 10-20 years of epic growth ahead, right? I mean, you got to pay up for that sort of company. The trend is your friend, and the long-term trend for Shopify is absolutely phenomenal. I believe it's a very similar company to Amazon in the sense of Amazon's always been a company that any big dip is a buy in the stock, right? Shopify's got a very different business model than Amazon, but when you look at Amazon, every dip's a buy. When you look at Shopify, every major dip's a buy. Every major dip's a buy. The 2022 crash was a buy. Last year was a buy. This year's a buy. Next year's a buy. The next year's a buy. The next year's a buy. Every year's a buy. Because these sorts of companies have basically like unlimited growth. That is basically what it comes down to. They're basically unlimited growth companies, and you're going to have to pay up for those sorts of stocks. So Shopify, I absolutely love this one. And, Amazon's a big position for me in the public count. We're up about $84,000 on Amazon so far. And Shopify is one of these stocks I'm looking at. I'm like, I need to just build that bigger and bigger and bigger. I would love to make Shopify the biggest, largest position in the Patreon portfolio. I would love to make that. I would love to make it the biggest position in the Patreon portfolio. Number 2 of these 7 stocks up here that I bought here today is Tesla, my Esla. Yes, I bought a little less than $8,500 worth of Tesla. Paid $168 for those shares here today. So, big new bullish vector for Tesla has just emerged. They're selling cyber hammers. Okay, now the hammer business is a pretty incredible business if you can sell your hammers for $700 a piece. Just kidding, okay? Although I will say that's pretty darn impressive. And it's funny, some folks in the private stock group, we got a lot of Tesla shareholders in my private group, right? Some were talking about, they were thinking about buying it, they considered it. They really strongly considered it. And honestly, I wouldn't be surprised at all if 2 months from now, people are selling those hammers for 2x or 3x the price that they actually got sold at. I wouldn't be surprised at all, because as things like that go viral, everybody gets talking about it. And then the more people can't have it, the more they want it, right? So I wouldn't be surprised if that would have been actually a good investment for a lot of folks out there. Now, Tesla. Oh my gosh. Everybody's got something negative to say about Tesla. Oh yeah, this and that, this and that. At the end of the day, what's the long-term trend with Tesla? It's up and to the right. And I don't see that changing any time over this next decade, right? We know 2024 is a bad year for the company. 2025 we know is likely going to be a more exciting year for the company. And then 2026 and beyond, things get really fun. But it is what it is, right? I'll deal with 1 year of bad. Here, I think about Tesla stock very similar to how I think about the stock market, okay? In the stock market, 7 out of 10 years should be good years in the market, right? 2 out of 10 years should be bad years, and 1 year should be like nothing year, right? Kind of went nowhere. So I'm willing to put up with that, and that's why I invest in the stock market, right? It's a great compounder of your wealth over time. And then if you can pick really great companies, then it's just exponential. And so I look at Tesla, a very similar situation, that I say, okay, for Tesla, if I look at the stock over a 10-year span, 7 out of 10 years should be really great for the stock. 2 years will be horrible for the stock. And 1 year will kind of be for the stock, right? And that's kind of what you get with Tesla. It's kind of what you get. I remember 2018 was a tough year for the stock, from what I remember, right? And that really went from mid 2018 into mid 2019. It was a really tough time. 2022, brutal year for Tesla. 2023 was a great year for Tesla. 2024, we'll see. It might be one of those May years where it's not really up, it's not really down by the end of it. We'll see, right? So that's kind of how I look at Tesla. Now, in regards to the situation, here's the deal. Look at the net income. The net income was massively negative for this company for many, many years. And now this company's had two straight years of net income, $10 billion plus, right? What a turnaround. Now, there's 4 mega trends going over the next 10 plus years, 4 of them. And you tell me which ones Tesla's leading in, okay? Mega trends for the next 10 plus years. Electric vehicles, clearly a mega trend. That's going and going and going, right? Are some years going to be faster for electric vehicle growth? Sure. Some years going to be not so exciting? Sure. But at the end of the day, it's very clear electric vehicles are the future, and those sales are getting stronger and stronger and stronger as the years tick on, right? AI-driven cars, mega trend. The cars driving themselves, don't need a human to drive it anymore, right? Mega trend for the next 10 plus years. Robo-taxi opportunity. This is an opportunity to get on your phone and a car pulls up to your house in 3, 4, 5 minutes and takes you wherever you need to go, right? And there's no human in that car. It's an Uber, but without an actual human driver, right? Mega trend for the next 10 plus years. And sustainable energy continues to be a mega trend for the 10 plus years. Now, how many of those are Tesla leading in? Well, I would say they're leading in electric vehicles. It's not even that's not even a question. Like, that's just a fact. AI-driven cars. My personal opinion is Tesla is leading in AI-driven cars. These other guys have tried to go the easy way out using LiDAR and things like that, and now they're starting to see bad results. I'm seeing more and more videos going viral of these, different cars using LiDAR, not even driving on the right side of the street, getting all confused and just being a mess. You need AI-driven cars. You need a car to think like a human would think and be able, like the best human driver possible. You need that to really make this a real opportunity, to be able to figure out, okay, I need to go over here, I need to do this, do that. You can't be driving on the wrong side of the street. No, okay. Robo-taxis. Who would be the leader there? Well, who's the company that's building all the vehicles, who's got the infrastructure in place to build massive amounts of vehicles, who's got the software and hardware that's likely going to be able to pull it off? It looks like Tesla's in the lead when it comes to that as well. In sustainable energy, we know Tesla's in the lead in regards to that, right? Obviously with their battery technology and electric vehicles. So if you look at these mega trends for the next 10, 20 years, Tesla's leading, in my opinion, all 4 of those mega trends. So that makes Tesla an insanely valuable company over the next 5 years, 10 years, 15 years, right? Number 3 of these 7 stocks up here that I bought here today is PayPal. $6,300 worth of PayPal stock I bought, $63 a share. Now, PayPal, the stock price has been horrible for the past 3 years. Horrible. But at the end of the day, look at PayPal's growth over time. It is such an insanely stable growth company, right? And if you look at PayPal's stock price, I mean, it went straight parabolic from like 2017, 2018 to 2021. Parabolic move, right? And then straight crash for the past 3 years. But that's the stock price. And that's Wall Street maybe way overvaluing companies and then way undervaluing companies, right? They don't really know what they're doing in the end, right? The long term, things will be figured out there. But at the end of the day, you look at the actual business, it's incredibly stable over the years. The revenue speaks for itself. If we look at their latest quarter here, net revenue came in at right around $7.7 billion versus just over $7 in the same quarter last year. If you look at operating income, $1.1 billion plus versus $999 million in the same quarter last year. Net income, $888 million versus $793 million in the same quarter last year. Diluted EPS, 83 cents versus 70 cents. That's the fundamentals of a business getting better and better and better and better. Now, this next thing is very, very important for where PayPal's profitability is about to go. They announced back in January, right, the very end of January, so we can basically call it February, that they're going to reduce their workforce by about 9% or so. Now, that wasn't reflected in this last quarter. That will really be reflected in the back half of the year. The back half of the year will really reflect what's actually going on with the workforce, and that the profitability starting in the back half of the year should go up exponentially and into 2025 as well, especially with their nice revenue growth that this company has. So get ready to see some pretty phenomenal earnings per share numbers next year. And even in the back half of this year, but next year especially. Now, Alex Chriss, he's done a phenomenal job so far coming in as president and CEO. He's only been at the company for, I would say, 6 months or so, maybe a little over 6 months, maybe 7, 8 months maybe. He's done a phenomenal job so far. Every step he's made, everything he's done, I've been like, good job, man. He's handled the conference calls very well. He's got a new gentleman that's about to start this upcoming week, investor relations. The company he's coming out over for has been an incredibly well-performing stock over the past number of years, and those investor relations folks are so important. So, man, I am nothing but happy with Alex Chriss, and he makes me much more confident in PayPal's long-term future. Stock number 4? Yeah, number 4 of 7 up here that I bought here today is Fubo TV. Fubo TV. Oh, I screwed up. Because I made these buys in my Ally account. I forgot Ally screws you if you buy stocks under $5. I had to pay a $44 commission for that today. You got to be flipping my flapjacks. Anyways, I bought Fubo here today. $5,100 in Fubo. Now, Fubo is a streaming company. They're a great player when it comes to sports-related content. As somebody that's a big college football fan, I love Fubo. It's the best out there. I can't find anything better. I put, there's a million college football games on. I put 4 games up on my big TV out in the living room, and man, it's just great. September, October, November, I love it, man. And so Fubo, and I stay a customer all year round because there might be other sports I watch here and there, but they have obviously TV channels and all those sorts of things, but their specialty is really in the sports market. That's their real specialty. If you're a big sports fan, like Fubo's the service for you at the end of the day, right? Now, when it comes to Fubo, the numbers speak for themselves. The revenue growth over the years has been absolutely phenomenal. And their subscriber numbers keep going up and up and up. Now, in regards to their latest income statement, they're making huge strides. The subscription revenue is going up, the advertising revenue is going up, the total revenue is going up. Meanwhile, they're keeping their expenses more in check. So their operating loss fell about $18 million year over year. So that's good. If we look at the loss from continuing operations, $56 million versus about $83 million in the same quarter last year. Huge improvement. Now, this is where things get very interesting and where it matters for Fubo, okay? The stock's $1. When you're a dollar stock, it basically means you're being priced for bankruptcy. because guess what's the next number to a dollar? It's $0, right? So when you're a dollar stock, you're being priced for bankruptcy. People think they're probably going under. But there's a significant chance that Fubo doesn't go under and they make it through this mess and they come out to the other side and it's a phenomenal opportunity, okay? And so let me run you through that. So if we look at Fubo over the quarters, the company has bringing down losses substantially. $153 million net loss, $152 million net loss, 84, 50, 84, 70, latest quarter $56 million net loss, right? This upcoming quarter, I estimate probably a $40 million net loss, maybe $45 million, somewhere in there. And so when you look at Fubo overall, the losses are coming down and coming down and coming down. Well, guess what's the next thing to happen after your losses keep coming down? You become break even, and then you turn profitable. When you turn profitable, not even when you turn profitable, when you turn break even, people take bankruptcy off. Then that's no longer bankruptcy. If you look at what's happened to Honest stock, right? Honest stock went from $1 to $3 plus in a matter of a few months. How come that happened? It happened because Honest went from losing massive amounts of money on their bottom line to now they're around break even. So now they just took bankruptcy off the table in regards to Honest. And so the stock went from $1 to $3 very quickly. If Fubo can get around break even, then that stock will also increase from $1 to $3 plus rapidly. Because as soon as you start getting around break even, people take bankruptcy off the table. And it's like, okay, this is an actual legit company now. And how profitable will they get? And that's a very different discussion versus are they going to go bankrupt? Are they going to have to raise money? Are they going to have to raise capital? Those sorts of things. And so Fubo could be a very explosive stock in the long term, but also in the short term as well. It's very important everybody understands that. Now, when I look at Fubo's balance sheet, as of the end of this past quarter, they had about $168 million of cash. So based upon my math, they should be good. They shouldn't need to dilute shareholder value. They shouldn't need to take out any more debt. They should be good. Because if they keep bringing down these losses rapidly, and let's say this upcoming quarter they lose 40 million, 45 million, something like that. Next quarter, maybe something in the 30s. It's just math. Do the math. As long as they keep bringing down those losses, you get to break even, and then cash isn't a problem anymore. And then it's about, okay, how much profit can the company start making, right? So looks good. Looks good overall. Now, risky? Sure, it's a risky stock, right? What happens if their losses, they don't keep bringing them down and they go up? Yeah, it's a huge risk. Huge risk, right? And in that situation, I'd be screwed. I'd lose it all. I lose everything I put in Fubo if that was a situation that happened. But based upon the cash balance and based upon how they bringing down these losses quarter after quarter after quarter, I'm not so confident that whole BK thing is going to happen, to be honest. And so if that doesn't happen, this is like a 10x plus opportunity. So if I'm going to put odds on it, I would say as of right now, given the information I have, I would put odds that there's about a 65% chance Fubo does not go bankrupt, and I would call it a 35% chance that Fubo does go bankrupt, okay? So the risk is still in my favor. And that's if it was a 1-to-1 kind of arbitrage here, right? Like I could double my money or I could lose everything. But this is not a 1-to-1 ratio. This is like a 1-to-10 ratio. Remember, there's a higher probability Fubo doesn't go BK, first off. But additionally, if they don't go BK and they make it out to the other side and they start getting profitable, then we're talking about this is like a 10x quickly opportunity. So if I put $1 in Fubo today, in 18 months, it could be 0, right? That's worst case scenario. My dollar goes to 0. Or my dollar goes to $10, $15 in 18 months, right? This is where Fubo gets very, very compelling. And that's why I take a risk in a stock like this. The risk reward makes sense for me to take that risk. And if it doesn't work out, it doesn't work out. Okay, I lose all my dollars I put into this one. But if it does work out, there's nowhere else I'm getting that sort of arbitrage in the market. Just not. I'm not going to get it. I'm not going to get a 10x plus opportunity in the next 18 months anywhere else. Tesla, Shopify, Nvidia, Palantir, I love all these stocks and they're my major investments, right? But I would also never risk the sort of money in Fubo that I have in a lot of these other big dog investments. You wouldn't see me put $800,000 in Fubo, that's for dang sure. You wouldn't see me put $300,000 in Fubo or $200,000 like I have on a lot of these stocks. But for me to put, tens of thousands, I'll take that. Because those, if I put 50 grand in the stock, right? That 50 grand could go to zero. I'm willing to take that risk. And it also could be $500,000 in 18 months from now, right? So that's where the arbitrage is with Fubo. We'll see how the whole show works out. Now, in regards to analyst community, a lot of analysts are very, very bullish on the stock. I was looking at some of these price targets and whatnot. These folks have, and these are usually 12-month price targets, $2.90. Now, it might not seem like crazy, like $2.90, $1.28. That's over a double over the next 12 months. Well over a double. $5? That's over a 3x, way over a 3x, right? You look at these folks, they're at $3. I mean, intriguing. Alrighty, folks. Next one up here. Number 5 of 7. And we'll get to the last two. SoFi Technologies. So at $6.96, added $4,100. Now, I just spoke about SoFi just a few days ago, very in depth. I did a 31-minute video covering them and Starbucks, and that was all I focused on in that video, so I don't really feel like talking about SoFi again because I just talked about them super in-depth. But SoFi, it's very attractive. It's a very attractive risk-reward. It is a company I love for the long term. It's a good setup. So anyways, if you want to hear more about SoFi, watch that video I put out 5 days ago. You'll enjoy that one, okay? Now, before we get into these last two stocks, folks, I got a brand new workshop I recorded for you guys a couple nights ago. 7 steps to 7 figures plus in stocks. This takes you through the 7 steps on how to achieve that. I take you through not just like what the step is, but what you can do for like an action plan to actually achieve that step. So then you can reach much higher levels, right? And I also teach you in that video some growth hacks I learned that hopefully you can adopt to scale much faster than I hit 7 figures. It took me from the time I started investing to the time I hit 7 figures in stocks, it took me around a decade, roughly. Around a decade, somewhere around there. And I think it's very possible to see somebody reach it faster than a decade. And I've seen a lot of people in my private stock group get there a lot faster than I. It took me over 10 years to get there. I've seen a lot of people in the private group get there in a matter of 3, 4, 5 years, some folks, right? A lot of it comes down to how much income do you have, how much expenses do you have, what's your rate of return, right? But anyways, that workshop is free to access. Pin comment down there. Takes you through a lot of that stuff that should help you. Number 6 of these 7 stocks I bought here today, Cheesecake Factory. Bought about $2,800 roughly of Cheesecake Factory. The stock is going up, so I don't usually like to buy when stocks are going up, but Cheesecake is a phenomenal opportunity. Now, in regards to Cheesecake Factory, they got their famous brand. We all know it, Cheesecake Factory, that restaurant, right? Then they have this next banger on their hands, North Italia, which is crazy big opportunity over this next 10 years. Then they have Flower Child, and the more I've gone to Flower Child and the more I've experienced it, the more I've started to realize that might be the biggest opportunity the company has in terms of locations. Because I'm looking at these Flower Child locations, I'm like, man, these could do crazy, like Uber Eats, DoorDash numbers long term in terms of delivery. And I'm also looking at them and I'm like, they're kind of building a lot of these Flower Child so far, big locations, big indoor, outdoor. But I was also thinking, man, they could build these probably in a Starbucks type footprint, but kind of make it a little bit more of like a to-go place rather than a sit-down, hang-out place. So they might adopt that business model in Flower Child. But the more I've looked at it, the more I'm like, this might be the biggest opportunity for the company in terms of amount of locations long term. On the latest conference call, they sounded very bullish on Flower Child. Then they have this big hit brand, Culinary Dropout, which if you've ever been to these, they're massive and they do crazy business. Now, this is not a high location amount they're going to be able to do for this one. I could see them maybe having 50 Culinary Dropouts in the United States long term. But, versus Flower Child, I could see them having maybe many hundreds or maybe even 500 Flower Childs long term. North Italia, I could think they could have, they're talking about 200 North Italias. I think you gotta have way more than 200 North Italias long term. So, but this one's a big volume. This is like a bar meets a sports bar, meets a restaurant, which has phenomenal food, by the way, meets a cool hangout place. I mean, it's the spot. Go to the one in North Scottsdale if you're ever in Arizona. Now, in regards to this, they have all these successful brands because they're FRC Concepts, which is basically a company they bought out by a very successful restaurateur, Sam Fox. This man is got an incredible track record when it comes to the restaurants. And so he's kind of got this like great mind for making restaurants that are successful, making great quality food with price points that are realistic and give a great experience. And I've been to so many of these because he does a lot of these restaurants and comes up with the concepts in Arizona, which is kind of like an unfair advantage to me because I spend so much time in Arizona here and there, right? Because I got family in Arizona. I have a house in Arizona, although I rent that house out nowadays, so I don't go to Arizona as much. But I've experienced North Italia. We also have North Italia here in Vegas. Flower Child as well, right? Culinary Dropout. I've experienced Blanco. I have also gone to Olive and Ivy. They got one in Scottsdale by Scottsdale Fashion Square, if you know where that's at. I've been to Flyby as well. So, and Doughbird. So, in Zinburger, I think I was actually there many years ago. So, man, everywhere the food's good. It's so legit. And so I'm like, I think every single concept they have is a potential hit. But the question is, what makes the most financial sense to expand around the United States, right? So that's where it comes down to that. Now, consumer sentiment's horrible. It's been horrible for the past 2 years. And this is starting to eliminate a lot of the weaker restaurant chains. And I've started to notice this even in Vegas. Companies that are kind of like restaurants that are kind of like so-so, they're going under. They can't pay their leases and they're going under. And so long term, that's a benefit to Cake because even in tough times, their restaurants are profitable. Even in tough times, they're still putting up huge numbers. And so we can even look back to the great financial crisis and, Cheesecake Factory's cash flows, even during that situation. And they're very, very impressive during the great financial crisis. And that's before they had all these other successful restaurant concepts like North Italia, Flower Child, and all these others. This was before that. Keep that in mind. So consumer sentiment, it's in a bad place. It's going to eliminate a lot of restaurants here. Now, if we look at 1000xstocks.com, we can go to the forward P of 12 in the stock, a PEG ratio, price to earnings growth of 0.64. The valuation's insanely compelling, and people don't understand this is a growth company. They just kind of think it's kind of like because they think about, it's called Cheesecake Factory. So you think about it in terms of like, they kind of got cheesecake factories everywhere. They need cheesecake factories and they can only fit so many people in the restaurant. So I don't even need to look into that stock because it's just kind of like a stagnant business. No, look at the numbers. It's not a stagnant business. When you start to do some digging, you're like, oh my gosh, it's a growth company. But a lot of fund managers and a lot of these Wall Street individuals, they haven't caught up onto the whole FRC concepts because they bought that right before Rona. Rona hit, devastated the restaurant industry. And so they don't even know what's going on, like in regards to this company right now. But believe me, over the coming years, the numbers will start to show themselves and then people will start to do some actual research here. Now, in regards to the type of opportunity they have here, right? Cheesecake Factory, like I said, like most Cheesecake Factories are already built at this point in time. You don't need a ton of those. Annual unit growth of 2 to 3% a year. They're talking about 4 Cheesecake Factory. North Italia, we're talking like 20%. Flower Child, I think, is going to be 20%, and I think it could go above 20% long term. And then Fox Restaurant Concepts in general, which is kind of the other ones that they're testing to see if they're the next big Flower Child, North Italia's, Cheesecake Factories. That's like 10 to 15% unit growth. Now, this is extremely important right here, okay? So what this is showing you, the kind of tan number here, this is showing you kind of like restaurants in general. Right, the restaurant sector in general, how they're faring as far as comp restaurant sales, right, versus Cheesecake Factory. And what you're going to find is throughout time, Cheesecake Factory does way better in good times than the other restaurateurs. And when times are bad, they do less bad than the other restaurants, which is a sign that you are a very well-run restaurant chain. If you can do as anybody that's ever been in the restaurant business, if your restaurant can do better than everybody else in good times and not as bad as everybody else in bad times, you're winning. That's the whole game, right? That's the whole game. And so Cheesecake Factory is incredibly successful here. The only time you could really find where they did worse was during the Rona year, right? Yeah, I don't think a Rona year is happening again. That's like once in 100-year type situation, right? So the bottom line is Cheesecake's an way overperformer versus the restaurant industry, and their overperformance has gotten significant recently. I mean, look at this. Last year, 13.9% versus 10.3% in a 2-year stack. Phenomenal. Now, the latest earnings, A- quarter overall, very good quarter. Revenues were up very nicely year over year. Net income up very nicely year over year. They're making an additional $5 million plus in net income a quarter right now than they were at this time last year. So those numbers are phenomenal. Number 7 of these 7 stocks is Wynn Resorts. I bought $2,700 of Wynn Resorts. Paid $96 a share. Now, Wynn's numbers are absolutely phenomenal. I mean, look at the latest income statement from Wynn that came out a few days ago. A- quarter here. Pause the video if you want. Look at that. That's a masterpiece there, folks. Masterpiece. Operating income, $362 million versus $169 million in the same quarter last year. Get out of here. Get out of here. Net income, $144 versus $12. Oh my gosh. So Wynn's business is great. I spoke extensively about Wynn, by the way, on 4 Stocks I'm Buying May 2024 edition. So if you want to watch that video on the channel, you can definitely check that out. Wynn was one, if I recall, it was one of the 4 stocks I featured in that video there. But here's the deal, okay? Wynn's not a love stock right now. The reason being interest rates are high. So people don't like to have a lot of these companies have to take out a lot of debt, a lot of the travel-related companies during time periods of higher rates, right? There's obviously always worries about the consumer, how the consumer's doing. And so those weigh on Wynn stock in the short term, but the numbers are phenomenal. And the numbers should continue to increase. Macau's still coming back. They're still coming back. Remember, Macau 18 months ago was almost closed down, right? Completely. And it was closed for like 3 years, significantly in terms of amount of travel. That's not like that anymore, folks. So love it. Alrighty, guys. Appreciate you joining me. Pin comment down there to get my brand new workshop for you guys. 7 steps to 7 figures plus in stocks. I think you get a lot of value out of that one. Much love and have a great day.